S&P 500 futures are down 0.3% in the pre-market, sitting right at 6,662. The NASDAQ is locked in this violent tug of war, and the VIX is definitively waking up from those 2026 lows.
Yeah, and if you look at the broad market sentiment dashboard this morning, Friday, March 13th, the needle is pointing straight to neutral. But, I mean, don't let that fool you.
Right, because the overnight session was completely hijacked by a geopolitical shock out of the Middle East. The implied open we are looking at entirely contradicts that calm facade.
That neutral reading is a complete mask.
Oh.
We are staring at a highly deceptive tape this morning. I mean, the pre-market volume is heavy, but the actual directional conviction from the smart money is incredibly thin.
It's all window dressing.
Exactly. What looks like a balanced market on the surface is hiding a massive, violent capital rotation underneath.
The best way to visualize this morning's market is like a duck floating on a pond. From the shore, looking at the major averages, the duck looks perfectly calm.
Right, but underneath the water, it is frantically paddling just to stay afloat.
And a massive driver of that frantic paddling today is institutional window dressing ahead of triple witching next week.
Yeah, the timing is the key variable here. For anyone navigating this tape, triple witching is that quarterly event where, stock options, index futures, and index options all expire on the exact same day.
It forces movement.
It does. Large funds are currently repositioning, rolling over massive derivative contracts and balancing their books. Nobody wants to be over-leveraged or caught offside heading into a weekend with, active global conflicts.
So we've got this illusion of neutrality artificially propped up by complex hedging, while the structural foundation of the market shifts.
Exactly.
To understand the direction of that shift, we have to isolate the macro earthquakes. It's a dual-threat morning. The overnight catalyst dominating the pre-market volume is Iran maintaining its blockade of the Strait of Hormuz.
Which is huge.
And look, before we break down the crude spike, we need to clarify for you, the listener. We are strictly analyzing the economic data, the supply chain disruptions, and the capital flows here.
Right, we aren't taking political sides on the conflict itself. We're just unpacking the math.
Just the math of the market mechanics. And the math represents a massive systemic shock.
It really does. The Strait of Hormuz isn't just a shipping lane. It is arguably the single most critical logistical choke point for global energy.
This blockade effectively takes 20% of the world's global oil supply offline in a matter of days. Brent Crude has already spiked past $102 a barrel in the overnight session.
But the energy shock is only the first half of the pincer movement, right? We have a massive macroeconomic catalyst hitting at 8:30 a.m. Eastern Time. The Core PCE print.
Personal consumption expenditures.
Right, which is the Fed's absolute preferred measure of inflation. They watch PCE way closer than the standard CPI.
Because it accounts for substitution. I mean, if beef gets too expensive and consumers switch to chicken, the PCE captures that actual shift in behavior.
Exactly. So if we get a hot, sticky PCE print at 8:30 a.m., right alongside this triple-digit oil price from the Middle East...
Doesn't that completely obliterate the soft landing narrative everyone has been banking on?
Oh, absolutely. Wall Street has been banking on this idea that the Fed could conquer inflation without triggering a recession. But a hot print today means the soft landing isn't just delayed, it's dead on arrival.
It forces the market to immediately price in stagflation.
Stagflation is the absolute worst-case scenario for central bankers. It's that toxic 1970s-style combination of stagnant economic growth and persistently high inflation.
Because they can't easily cut interest rates to stimulate the stalling economy, right?
Yeah.
Doing that would just pour gasoline on the inflation fire.
Right, and the rate cut expectations prove this. Coming into the year, everyone assumed cuts were locked in for July.
But the overnight data shows those are already pushed all the way up to September.
Because that 102 oil price isn't just a premium you pay at the pump. It acts as a direct, unavoidable inflation tax on the entire global supply chain.
Everything costs more to manufacture, more to package, more to transport. And that brings us to the collateral damage of this macro environment. We need to look at how this specifically targets the absolute darling of the 2024 and 2025 market big tech.
The divergence here is staggering. Tech is finding itself caught in a brutal tightening vice.
We're tracking two specific macroeconomic headwinds driving this pre-market action. First, the 10-year Treasury yield is sitting at 4.27%.
Which is massive.
Up 22 basis points just this month. That's a violent move in the bond market. Second, the U.S. dollar index, the DXY, is sitting strong at 100.05.
And those two specific data points act as kryptonite for high multiple growth stocks. We're watching the classic pain trade unfold in real time.
The retail mindset right now is fascinating,
Yeah.
but incredibly dangerous. Retail investors have been conditioned over the last 5 years to treat tech as a safe haven.
Oh, completely.
You see the NASDAQ dip, and their muscle memory instantly triggers a buy order. But the institutional order flow shows the smart money is actively derating the NASDAQ today.
Because the institutions aren't looking at the dip, they are looking at the mechanics of those two headwinds.
The way I'm looking at this dynamic for a high multiple AI tech company, it's like trying to sprint a marathon while wearing a weighted vest.
Right.
The yield is the vest. But I'm also looking at this DXY number at 100.05. If I am an AI company selling enterprise software in Europe, a strong dollar means my overseas revenue is literally shrinking by the time it gets converted back to my balance sheet.
Yeah.
So is the currency exchange the actual headwind knocking these stocks back today?
Well, the currency exchange is a severe headwind, absolutely. I mean, if you report your earnings in dollars, but your clients are paying you in depreciating euros, today is a losing day, purely on the Forex desk.
Right.
But we need to look closer at the weighted vest because the yield is the anchor dragging the entire sector down. In finance, the yield on the 10-year Treasury acts as the fundamental discount rate for future corporate earnings.
Walk us through that mechanical relationship. Why does a bond yield dictate a software company's stock price today?
So tech companies, especially in the AI space, are valued based on the massive profits they're expected to generate 3, 5, or 10 years into the future.
You are paying a premium today for tomorrow's growth.
Exactly. But to calculate what those future profits are actually worth in today's money, analysts discount them backwards using the risk-free rate of return, the 10-year Treasury.
So when the yield on that risk-free government bond goes up to 4.27%,
the present mathematical value of those future tech profits aggressively drops. It is an immediate valuation compression.
we are seeing this reality check play out in the pre-market gappers right now. Look at Adobe, ticker ADBE. They are down 4% pre-market.
Yeah, that's a big move.
They actually posted a narrow earnings beat, but they offered a soft Q2 revenue outlook. This signals that the Phase 3 AI monetization cycle is seriously lagging behind what the street aggressively priced in.
Phase 3 is the critical hurdle here. Phase 1 was buying the semiconductor chips. Phase 2 was building the data centers and the large language models.
Right.
Phase 3 is actually selling AI-integrated software to enterprise clients, and proving it increases productivity. Adobe's soft guidance tells institutions that enterprise clients are hesitating.
The market is entirely losing its patience with the concept of growth at any price.
Yes, exactly.
But then you have Oracle, ticker ORCL, completely bucking that trend. They're the designated AI earnings hero this morning.
They really are.
They delivered a massive Q3 beat, raised their 2026 guidance, and the pre-market volume is heavily rewarding them. The key levels for Oracle today: upside resistance target of $142, downside support at $118.
The distinction between Adobe and Oracle is the decoder ring for the current institutional mindset. Oracle is being rewarded because they are proving tangible, contracted AI revenue today.
While Adobe is asking investors to wait another 2 quarters.
Right, but the real risk here is structural. If that 10-year yield breaks above 4.30%, even Oracle's multiple will compress.
Wow, so even the winners get dragged down.
Yeah, retail investors buying the broad tech dip are stepping into a buzzsaw. They're failing to realize that in a 4.3% yield environment, the actual fair value for the NASDAQ is structurally lower than it was last year.
But capital doesn't just evaporate, right? It relocates.
Exactly.
If the institutional money is bleeding out of tech because of this yield environment, it has to find a home. It cannot just sit on the sidelines.
Right, which brings us to the Hormuz hedge and the aggressive capital flow into hard assets.
In a stagflationary environment where inflation is sticky and growth is stalling, the institutional playbook is incredibly rigid. You rotate out of speculative growth and you buy energy and basic materials.
You buy things that are tangible. When currency is actively losing its purchasing power, you want to own assets that actually exist in the physical world.
And the pre-market heat map is glowing green in exactly those 2 sectors. Let's look at the specific movers. Mosaic, ticker MOS, is jumping 3.5% pre-market as investors scramble for defensive commodity exposure.
And Occidental Petroleum, ticker OXY, is serving as the institutional war proxy.
Why OXY specifically compared to the broader energy sector?
Because of their production profile, they have a very lean, heavily domestic operation in the Permian Basin.
So they aren't relying on vulnerable oil tankers trying to navigate a blockaded strait.
Exactly. It's a high beta sensitivity play, meaning its stock price is hypersensitive to crude prices and will swing much more violently than the broader S&P 500.
And the pre-market levels for OXY reflect that volatility. The bull case target today is $68, assuming Brent Crude holds over $100 and the Strait of Hormuz remains closed through the weekend.
Right.
The bear case drops to $54.50 if we see aggressive Friday profit-taking or sudden diplomatic ceasefire rumors.
Yeah, but the ripple effects of this blockade go way beyond the gas pump.
Right, and this is the data point that fundamentally changes the scope of today's market. With the strait closed, it is not just 20% of global oil that's offline. It is 35% of global ammonia and urea exports.
Which are the absolute foundational building blocks of modern agricultural fertilizer.
Let's connect the dots on this mechanism, because this is where the geopolitical shock becomes an economic crisis. How does a blockade in the Middle East cripple global agriculture?
It comes down to chemistry and natural gas. The Middle East is a massive processor of natural gas into anhydrous ammonia. When you shut down that export channel, the global supply of nitrogen-based fertilizers just collapses.
Oh, wow.
Yeah, if farmers in Europe, India, or Brazil cannot secure fertilizer for the upcoming planting season, global crop yields will plummet.
Which means global food prices skyrocket, injecting a massive secondary wave of inflation directly into the grocery aisle.
Exactly.
So this isn't just a gas pump story anymore. This is a literal global food security trade. Are North American chemical producers suddenly becoming the lenders of last resort for the global agricultural system?
They absolutely are, and the capital flows explicitly confirm this. Institutional money is flooding into domestic producers to front-run this looming agricultural crisis.
CF Industries, ticker CF, is the prime example. They are a pure play on the global nitrogen shortage. Their pre-market volume is currently sitting at 4 times their normal 10-day average.
4 times.
Yeah, the upside target for CF today is stretched all the way to $148, fueled entirely by European and Asian supply remaining stranded.
This specific rotation dumping Adobe in software and aggressively piling into CF Industries and domestic energy is the exact reason the broader market indices look neutral.
It perfectly balances out.
Right, the heavy selling pressure in discretionary and tech stocks is being perfectly counterbalanced by this desperate flight into hard assets.
The frantic paddling under the calm surface. Understanding this sector rotation gives you the macro why. But if you are actually stepping into the market today to survive the session, you need the mechanical how.
You definitely.
You need to understand the structural traps being set for the opening bell.
Because on a Friday the 13th, with triple witching looming and a fundamentally deceptive tape, human emotion is a liability. The algorithmic machines are entirely in charge of the price action today.
Let's define the battlegrounds, starting with the S&P 500. Rather than rattling off a dozen different support levels, we need to focus on the absolute line in the sand.
Right.
For the S&P, that line is 5,925. The data flags this specific level as the high gamma flip point.
And to survive today's tape, you have to understand the mechanics of a gamma flip. It dictates the behavior of the largest players in the market, the options dealers.
Right, they have to remain market neutral.
Exactly. If the S&P stays above 5,925, the dealers are positioned in a way where they actually buy into small dips, stabilizing the market.
But if we drop below 5,925,
the math flips entirely. If the S&P crosses below that threshold, the dealers' hedging requirements invert. They are suddenly forced to aggressively sell futures to protect their massive options portfolios.
So it creates mechanical avalanche.
Yeah.
Selling triggers more selling.
Yes. So 5,925 isn't just a line on a chart, it is a structural trapdoor.
Above that trapdoor, we have a resistance ceiling parked at 5,955. There is heavy institutional supply waiting there.
Massive supply.
If you see the S&P push into 5,955, do not chase it unless you see a sustained 15-minute close above that level to confirm the breakout.
Right.
For the NASDAQ, the tug-of-war is similarly constrained. The line in the sand is 21,450. The resistance ceiling is 21,680. And the absolute floor is a massive put wall sitting at 21,200.
A put wall is a massive, concentrated strike price where thousands of put options expire today. When the index drops into that 21,200 level, the sheer mechanical volume of those options acts like a physical trampoline.
It forces a sharp, violent bounce.
Exactly. It provides structural support, but it also traps the index in a tight range.
So the ultimate verdict for the opening bell, looking at these rigid boundaries, is that we are stepping into a liquidity trap. The overnight notes explicitly warn that any early breakouts will lack follow-through volume.
It's a scalp trader's market, not a trend trader's market. The specific price action we are looking for is called fade the move. Do not trust the gap and go.
Let me break down the mechanics of that trap. Say we see a big, exciting green candle right after the opening bell, pushing the S&P past that 5,955 ceiling.
Yeah.
Retail traders, conditioned by years of up-only markets, see that momentum. Fear of missing out kicks in, and they aggressively buy the breakout.
And that retail FOMO is exactly what the institutions are relying on.
Right.
Large funds have millions of shares they need to offload as they reposition for triple witching. They cannot simply sell those shares into a quiet market, or they will crash the price and ruin their own execution.
You need buyers.
They need a surge of buying pressure to take the other side of their massive block orders.
So the breakout is an institutional mirage. They use the rush of retail buy orders as exit liquidity.
Exactly. And the second those institutional sell orders are filled, the buying pressure evaporates, the floor falls out, and the market sharply reverses,
Leaving the retail trader holding the bag at the absolute top of the morning range.
It requires immense discipline to survive a tape like this. You have to sit on your hands when the momentum looks the most enticing.
Trust the mechanical boundary.
Yes. Trust the 5,925 flip point, the 21,200 put wall, over your own emotional instinct to chase the green candles, and keep your position sizing incredibly small.
To bring this all together heading into the bell, do not let the neutral surface deceive you. Keep your eyes locked on the 10-year Treasury yield. That 4.30% line is the ultimate anchor for the tech sector.
Right.
Recognize the Hormuz hedge playing out in real time as capital violently rotates out of high multiple growth and seeks shelter in domestic energy and agricultural producers like OXY and CF industries.
And mechanically, refuse to be exit liquidity for institutional window dressing. Play the edges, buy the structural floor, sell the resistance ceiling, and do not commit to a heavy directional bias until the final hour of the trading session.
We spent this entire pre-market session analyzing how capital is fleeing the tech sector and scrambling to find a home in physical commodities and defensive hard assets.
Yeah.
But watching this massive structural rotation raises a critical question about the traditional playbook.
It really does, particularly regarding the nature of risk itself. I mean, we are watching the 10-year yield march toward that critical 4.30% threshold.
And we are watching the retail narrative that tech is an invincible safe haven begin to buckle under the weight of this new inflation tax.
Exactly.
So if hard assets become dangerously crowded and tech multiples continue to compress, where does the smart money pivot next?
That is the exact scenario the macro strategists are quietly modeling right now. If the yield definitively breaks through 4.30% and stays there, how long will it be before simply sitting in cash stops being viewed as a temporary defensive shield and actually becomes the single most aggressive strategic weapon in an active trader's arsenal?